The streaming war just exploded and the market is reacting fast. We've got Netflix, Paramount, Skydance, and Warner Brothers Discovery all circling the same assets, and the numbers being thrown around are massive. One offer implies $30 a share, another represents more than $17.6 billion in cash. And while Netflix's co CEO is out publicly saying he's super confident they'll end up the winner, investors clearly don't agree. Netflix stock has dropped nearly 12% in just a week, and volume has almost doubled. That tells you traders are repositioning aggressively. So let's break down what's actually happening here, what the market is signaling, and how investors should think about trading this situation right now. First, Netflix. Despite the confident messaging from management, the stock is flashing real weakness. It's now trading below the bottom end of the collar tied to their proposed deal structure, which means the value of any stock based offer has declined. That alone creates pressure, but Netflix still has room to maneuver. They can widen the collar, they can add more shares, they can change the structure, or simply raise the offer. They have a flexibility, and that's important because the market is starting to price in the expectation that Netflix isn't done bidding. Now, let's talk about the Skydance and Paramount side of this battle. Their proposal has completely reshaped the narrative. Valuation assumptions in the $26 billion range are forcing everyone to re evaluate what these businesses are worth, especially the difference between the core traditional assets and the streaming division. Paramount says they have the superior regulatory path. They say the approval process is cleaner, but then they also claim they never got the chance to submit their best and final offer. That opens a big question. If they had more to give, why didn't they bring it when bids were due? That uncertainty is exactly why the stock is not trading anywhere near the $30 target. Wall Street believes the timeline to close this deal is long, and when timelines stretch, arbitrage funds step back. Now, many investors are wondering why Warner Brothers Discovery isn't moving higher despite being at the center of all this attention. The answer is simple. First, nobody knows how long the closing process will take. Second, regulators will absolutely scrutinize a combination involving assets of this size. And third, option traders with early year expirations don't want to hold positions that could lose value simply because the deal drags on. All of that creates stagnation in the share price. So, where does the stock go from here? Right now, the short term ceiling looks like $30. That's roughly $2.5 of upside, but the downside includes a move back into the low 20s if the rhetoric heats up or if one party backs away. A complete slide back to 18 is unlikely but not impossible. In this type of environment, the risk reward is very dependent on your time horizon. Short term traders are cautious, long term investors are watching for strategic value. But the real question driving this entire saga is simple: what are the legacy cable channels actually worth? If they're worth more than 20 to 50 per share, Netflix's vision suddenly makes sense. But if they're worth less, Paramount's argument strengthens. One side believes these assets continue to throw off meaningful cash, the other side believes they're declining faster than the market realizes. Until there's clarity on that valuation gap, we're going to keep seeing back and forth movement between the bidders. So, what's the actual trade right now? For Netflix, the setup is surprisingly attractive. Even after the pullback, the valuation is compelling compared to where it has been. A lot of the growth concerns are already priced in. The fear of paying too much for an acquisition is also priced in, and the stock is holding the same levels it reached at its all time highs in February. If Netflix announces a disciplined offer, the stock could rebound quickly. For Warner Brothers Discovery, the opportunity exists, but the timeline hurts. This is a slow path with regulatory complications, and headline risk will drive most of the day to day movement. For Paramount and Skydance, this is far from finished. Paramount claims they still have room to raise their bid. Netflix hasn't shown its true hand yet, and Skydance is pushing hard to structure something creative. This is only the beginning of the negotiation. The biggest takeaway for investors is this: the situation will move slowly. Approvals take time, board decisions take time, and bidding wars almost always play out over months, not weeks. If you're trading short dated options, be careful. If you're investing for the long term, focus on who has the strongest strategic position, not who's making the most noise. Right now, Netflix still looks like the most compelling strategic play, but Warner Brothers Discovery and Paramount remain at the center of an industry defining moment. This story is far from over, not even close.